Hey everyone, welcome back. Now, in my last couple videos, I talked about how I saved $500 a month through budgeting. And I also talked about how saving $150 a month could make you a millionaire if you invest that money properly. Now, you might say to yourself, okay, that's all well and good, but once I have this money saved, what do I do with it? How do I actually invest it to make myself some passive income? The first option is to invest in yourself through education that gets you a higher paying job. Now, this is a really good option, especially if you're younger, because generally these kinds of investments will get you a much higher ROI than investing in anything else. Another good option to go with is real estate. Real estate can give you some incredible returns on investment if you have the time and the expertise to deal with it. Now, a lot of people don't have the time to actually get involved in real estate because it does require a certain amount of effort. It's not exactly passive. Furthermore, real estate often requires some sort of upfront investment, and if you don't have enough saved up for that, you're going to have to wait a while before you can invest. Now, the final option, which has been blowing up recently in the news and on YouTube in general, is stock investing. Most people have at least some idea of what stock investing is, but on a fundamental level, what a stock is a piece of ownership in a company. When I buy a stock of Apple, I am buying a small piece of Apple. In exchange for owning that stock, Apple might pay me some sort of dividend each year out of the profits they earn, or I might make money simply by the value of the stock going up, meaning that whoever I bought the stock from sold it to me at a lower price, then I can later sell it to another person. Both of these are totally valid ways to make money in the stock market, but they require a little bit different strategies. Now, before we get too far into it, you might be asking yourself why you should even listen to me with stock investing. Well, I'll be the first to admit I'm no Warren Buffett. I'm not a stock guru. But I have been investing in stocks for quite a long time. Since I was about 12 years old, I've been reading books on different types of stock investing, including growth investing, dividend investing, or value investing. I've also been actively invested in the stock market since I turned 18 7 years ago. At the same time, for the past 3 years, I have been actively investing in the stock market. This means I don't just leave my money in a mutual fund or an ETF, which is managed by someone else. I actually control my own portfolio and am responsible for any gains or losses that I accrue. This has been taking place for the last 3 years, and during that time, I have averaged, over that time, I have averaged a 42.42% rate of return on my Roth IRA self-directed account. I also have a 401k account, which is just tracking an index fund, and that kind of acts as a hedge for me in case I go off the rails and make some really bad stock decisions. At least I'll still have some money that is controlled by someone else. Originally, when I first opened the Roth IRA, I thought that this would just be my small account on the side, which I could kind of play around in order to learn more about the stock market. What ended up happening is I ended up vastly outperforming the broader market in my individual Roth IRA. Granted, a 42.42% rate of return over 3 years seems a little bit ridiculous, and it is. I don't expect to make that going forward. In fact, a big part of those gains is because in 2020 so far, I've made 62.93% in just the last half year. Now, I'll be the first to admit that a big part of that increase was chance because of the illness that affected the entire world over the last 4 months. Now, this illness just happened to affect the companies that I like to invest in a very positive way. If you're interested, I may make a later video going over my exact portfolio and how I achieved these returns, and no, it was not Tesla. If you are just getting started with investing and have no idea what you're doing, my first recommendation would be to use some kind of mutual fund or an ETF. Now, a mutual fund is just where you and a bunch of other people all put your money together and you hand it to a mutual fund manager who says, okay, I'm going to pool all of your mutual funds together and then buy a series of stocks that I think will outperform the market in the long term. Now, theoretically, the advantage to mutual funds is they have an entire team of experts who can analyze all the stocks on the market and pick just the stocks that will perform the best for you. The problem is, in reality, the vast majority of the time, mutual funds actually vastly underperform the larger market when you account for the fees that they charge you every year in exchange for managing your money. A better option might be ETFs or an index fund. Now, an ETF, or exchange-traded fund, is basically just a fund that trades based on some predetermined criteria, without the use of expensive fund managers. So for example, you could have a luxury goods ETF which buys companies that sell luxury goods. And this fund would basically just invest your money into all the different stocks that sell luxury goods without much turnover or need to actually analyze individual stocks. This drives down the management fees so far that it actually increases your total return because your returns aren't going to some fund managers. Now, there's a more specific class of ETFs, which are ETFs that track some form of index. Now, an index could be the S&P 500 or the NASDAQ or the Dow Jones Industrial Average, all these different things that you hear about on the news all the time. An ETF which tracks an index is known as an index fund. An index fund is a great way to get your stock performance to match the broader market. And studies have shown that investing in an index fund is often the best choice for your average investor. As long as you leave your money in an index fund over a long enough time period, you'll usually average around a 9% rate of return during that time. This is also a really good way to get your feet wet without taking on the risk of investing in individual stocks. Again, if I did not have much experience with stock investing, I would do exactly what I did when I was 18 years old and just invest in an index fund. But if you want to maybe take a little more risk and also have some sort of influence over how your stocks perform, you can try picking a sector ETF to maybe give yourself a little bit more experience with investing. For example, let's say that I think that over the next 5 years, technology stocks are going to do better than the broader market. Well, one way for me to invest in technology stocks would be to invest in an ETF that tracks technology stocks. For example, maybe an ETF fund that tracks the NASDAQ. An example of this is the QQQ fund. Let's say you think real estate is going to do better than the broader market. Well, in that case, you can invest in an REIT ETF, which basically just allows you to invest in a basket of real estate investment trusts. One such fund is the VNQ ETF. Investing in ETFs in this way is a good way to give yourself a little bit of exposure into actually making decisions that affect your investment outcomes without taking on the higher risk associated with investing in individual stocks. I would recommend doing this for a couple years to actually get comfortable with stock investing before diving into individual stocks. I would say before you get into individual stocks, you should be aware of at least some basic terms involved in stock investing, such as PE ratios, revenues, profits, and other basic investing terminology. You can find a lot of this basic terminology in Investopedia's Investor Beginner Guide, which I'll link in the description. This is actually a really good starting place if you don't really know how to get involved in stock investing in the first place. Now, I know everybody wants to get involved in investing in individual stocks because that's what's cool, that's what's fun. But again, most people who invest in individual stocks and put all that time and effort in will actually make less money than if they just left their money in an index fund. In fact, 80% of people who invest in individual stocks underperform the broader market. Now, I do invest in individual stocks, so I'm not going to sit here and tell you not to do it. But if you do it, you should do it in a structured and well planned out way. I'll probably make a future video focused just on how I invest in individual stocks, which can maybe act as a starting point for you. The last thing that I want to leave you with today is a potential warning. I've been seeing a ton of videos on YouTube coming out recently around stock investing, more than usual. And I think the reason for that is because we've seen a crazy bull market during the illness of the last 4 months, and people are getting really excited about getting invested in stocks. Now, I think this is a great thing because stock investing has the potential to generate a ton of passive income, but at the same time, you need to be careful. Just because everybody else is investing in the stock market doesn't mean that you should. In fact, it probably means the opposite. There's this famous story on Wall Street that warns us exactly about this situation when everybody seems to be getting into the market. The story goes that back in 1929, there was this investor named Joe. Now, this was just before the start of the Great Depression, and Joe was just going about his business as usual. He was getting his shoes shined when suddenly the guy shining his shoes decided to offer Joe a stock tip. Joe continued on with his day, and then he got into a cab later. His cab driver then proceeded to also offer Joe a stock tip. Joe then went on to his office and immediately sold out of all of his stock positions just before the crash that started the Great Depression. The reason that Joe knew the market was going to crash is because he figured if the guy who shined his shoes was invested in the stock market, and the guy who was driving his cab was invested in the stock market, there wasn't really anybody left on the sidelines. Everybody who would ever get into the stock market was already in it, which meant it couldn't keep going higher, and eventually it had to drop. Now, I'm not saying that we're going to see a market crash anytime soon. But what I am saying is you shouldn't invest in the stock market just because everybody else around you is. Don't try to time the market. Don't buy into the stock market because everybody else is. And don't avoid buying into the stock market just because a lot of other people are also. The most important thing with investing is consistency. So all I will say is, if you want to get invested in the stock market, go for it, do it. But make sure that once you do it, you're willing to stay in the stock market for at least 20 years. That way you can ride out any ups and downs in the market and still make a good rate of return over that entire time period. With that said, I hope you enjoyed the video. If you did, leave a like. And if you want to see more videos like this in the future, make sure to subscribe to my channel. I'll see you next time.